Jake Miller, co-founder of Opto Investments. What are the major trends in private markets that are relevant to wealth managers and their firms as we enter 2026?
Yeah, as we're entering 2026, we're thinking a lot about what the overall economic conditions look like. There are times where you don't really have to focus on the big picture as much. You should never totally ignore it, but you don't have to focus on it as much. And there's times where that macro backdrop will matter a lot for where you should be focusing your time and effort in private markets. And we see both 2025 and looking ahead in 2026 as a time where that backdrop really matters. And we see this as a time of divergence. There's a lot of policy-driven pressure, so things that are exogenous to the core economy that will impact different sectors of the economy really differently. We have fiscal acceleration. You have the government planning to spend a lot on energy infrastructure, on logistics, on defense, in a way that is pretty atypical for this point in the economic cycle. We're not in a recession yet, at least, and so this sort of boost to fiscal spending is pretty unorthodox for this point in the cycle. You have continued impacts of tariffs. Obviously, that shock was in 2025, but it's still rolling through the economy. We haven't worked through all the inventories yet, so continuing to see how that evolves. You have deregulation hitting the financial sector, and so the rollback of a lot of Basel III provisions and other things that were preventing banks from playing a role they had traditionally, which led to, honestly, the growth of the private credit space. And so as you remove those regulations, will you see more pressure on private credit from traditional banks? And then this massive cycle that's emerging in CapEx for AI and chips. And that's both public and private. Obviously, you have some government announced programs around chips and AI, but also just massive CapEx plans for major players. And so this won't impact all the private markets the same. When you talk about things like onshoring, when you talk about less global trade, when you talk about um, even parts of how that fiscal acceleration will hit, that's a lot of stuff that will really benefit super lower middle market private equity. The people who own a lot of logistics yards who can participate in the construction of the uh, infrastructure, et cetera, and it will be less relevant towards larger growth oriented private equity or to just multifamily real estate or something like that. AI capex, obviously has a lot of implications for venture capital, but not always in the same way. Will that money only flow to the largest players? Will it help the small startups? What are the key parts of the plumbing of the AI revolution that have not been built yet, where there's still potential to find companies that are not overvalued? We don't see AI as a bubble, but that doesn't mean there aren't sectors that are uh, more expensive than you'd like to enter if you want venture-like returns. Um, and so we really try and map, think about it as two axes. What are the what is a macro backdrop telling us about where we should be looking? And then how does that align with core, just 10-year sort of investment themes that are sitting orthogonal to that? That makes us particularly interested in, again, like really smaller, lower middle market private equity. We think there's a lot of opportunity in the more kind of fractured areas of supply chain, logistics, manufacturing, building, construction in two areas that are impacted by AI. One is really zeroing in on those parts of the AI infrastructure that need to be built. And then two is who can just apply AI to reduce costs into things like back office processes in credit unions. Like AI agents are great for moving that along. Could a private equity firm buy credit unions, implement new technology, and increase margins? Could you do the same thing in hospital billing, in permitting for construction? What are those really low-hanging fruit areas where AI agents could be really helpful in increasing margin? Um, and then there are parts of the just the core infrastructure sector that uh, are likely interesting. Because of the deregulation push, we are that'll impact private credit in two ways. One, it Probably means there'll be higher availability of credit, and so maybe lower defaults, but it also means there'll be a lot more pressure on yields and a lot more competition for deals. And so we're a little bit more skeptical about especially large private credit heading into 2026, just given the oncoming competition that those firms will likely face from banks who have a lot of dry powder to put to work.
Thank you. And with that in mind, what is Opto working on in 2026 for his clients?
Yeah, so in line with this, one of the core problems a lot of our clients face is how do I deal with the massive amount of information that I get sent? And so if you are a wealth manager today, you are probably being sent between 5 and 500 pitches a week from various managers in private markets or in alternatives more generally. And if you are like me 3 years ago, most of that, you look it over if you have time, most of it ends up in the archive in your email in a PDF and you never look at it again. Now, from a investment outcome perspective, that's probably fine. You aren't going to invest, you should only invest in, 0.5% to 2% of the stuff you're sent. Should be a low pass rate. But from a data perspective, that's bad. You're losing a lot of really important information about what's happening in the industry, even if you don't choose to invest with that manager. You might learn how cap rates are evolving, how different managers are positioning around yield, or just like what overall volume is for fundraising and venture. And so we built a AI native screening tool where you can set this up. You can train it on your firm's investment committee memos. And anytime you're sent any information from a manager, you can drop that in system or forward that and have it automatically populate a entry in your internal proprietary security master. So you can start to build out a comprehensive view of everything that you know about and really start to benchmark everything that you see basically in a very automated way so that the way we see it is that sort of work often takes call it a 2 to 4 year analyst 5 to 8 hours to really do for any manager. If you can do that in 2 to 3 minutes, that really changes the volume you can look at and changes the amount of insight you can have across all of what's happening in alternatives.
Jake, I think this is very useful information. I greatly appreciate it. Thank you for your time.
Thank you.